Jim, welcome to the Income Flip, brother. How are you?
Good, Rob. Thanks for having me.
Hey, man, it's my pleasure. Um, it's been hot as anything here on the East Coast in Virginia. I'm just curious, what's it like today in Jacksonville, Florida?
It's Florida hot, but I'm right next to the ocean, so that helps.
That definitely helps. That definitely helps. Hey, well, I appreciate you spending some time with our grid community. What I wanted to do was unpack a little bit about this build to build a kind of like rent space, right? Build to own space.
Yeah,
And I want to, but before we dive into that, what I want to do is go back in time and understand a little bit about your journey and how
sure.
you even got into this wonderful world of real estate investing and what brought you to where you are today.
Yeah. So I've been a real estate investor for 24 years now. That doesn't even sound right because I was that age when I got into it. So holy cow, doubled the age, and a lot of bumps and bruises along the way. But I started in California, and a mentor of mine taught me that if you're really going to be good at real estate, you want to be able to try to say what you do in one sentence. And that was a
Mhm.
great lesson for me. So when I first started out, I would buy, fix, and resell HUD foreclosures. I was doing that in a little market called Bakersfield, California. And
Mhm.
then I started to buy, fix, and rent HUD foreclosures and other distressed properties. And then around 2004, it was getting crazy out in California, and I left because I didn't know the meltdown was going to happen, but just the numbers didn't make sense. So I came to Florida, started buying rentals again, and then the meltdown happened. We were very lucky to survive that, be heavily invested in California and Florida. But also what happened was the foreclosure market really opened up, as you know, at the end of
Mhm.
'08. And there was just everything was on sale. So we built a business doing bulk foreclosures where we buy them, renovate them, and either keep them for ourselves as rental or work with other investors.
Mhm.
And that niche did really, really well for us. But there were a lot of headaches, a lot of setbacks with rehabbing older properties. And I don't have to say that to all the rehabbers out there. So by about 2014, 15, started to get pretty busy here, Rob, in the Northeast Florida area. Everyone wanted to be buying fixer uppers. So me and my now building partner said, what if we actually built our own properties instead of looked for the older properties to fix up? So we experimented with our first uh, 28 properties, that were old, a couple of extra lots from a bigger development that had sold the final lots. And that first year we did 3 million in property. Last year we did 185 million in property contracts.
Mhm.
So
Mhm.
it took off in 9 years, and there was a lot to the build to rent that we found we couldn't scale with the fixing up old foreclosures. So it's been a really good thing for us, for our clients, and you hear about it now in the Wall Street Journal. The big financial newspapers are talking about build to rent when the term didn't even really exist 9 years ago. Uh,
Mhm.
it has a lot of money in the space now. Depending on the area, I think it can be really well, and it's definitely been my favorite niche in real estate so far.
Hmm. Well, let's unpack that a little bit. Explain to our audience what the build to rent space looks like. What is
Yeah,
it?
so yeah, it's a great question. What we do is we go into high growth areas in Florida. We started in Jacksonville and then grew into another dozen markets in Florida. But we go to high growth markets in Florida that have population growth, economic growth, a good affordability index, which just means the average family income per household can buy the average house for that area, and then something desirable about the area, what's drawing them there, and then healthy supply and demand. Obviously, you're building houses, you want supply and demand to be, in healthy equilibrium. So we like to go where there's a need for houses, not an oversupply. And we help investors build portfolios with new construction properties. And the advantage I've seen, from doing thousands of older rehab properties to new construction, there's less headaches, less maintenance and repairs. We call it the 3 year curse, Rob. I own a lot of older properties, but after 3 years, I know my maintenance and repairs is going up. I got a budget for it. Even
Mhm.
if I do a new roof, heating and cooling, plumbing, upgrade electric, kitchens, baths, there's been more. And we haven't seen that 3 year curse hit with our new construction properties 9 years in because we were able to build them with more durability uh, right from the get go. So the materials we're using are better quality than were used, back in the era that we were taking over from. So there's less guesswork, less involvement. Most of our investors we work with, they're really busy. They have a successful business or career, and they're wanting to be involved in real estate, but not get their hands too dirty. And that's what new construction has allowed us. We can see the amount of time, the amount of turnover goes down significantly with the new construction model.
So let's unpack that new construction model. And by the way, and then when I'm going to go back and I'm going to unpack a little bit more about your background because I'm
Yeah, yeah.
interested, right? But let's unpack this. Um, what is the average? What does the average purchase look like? What's the rent to purchase ratio? Just averages, right? For
Yeah,
a
yeah. So we focus on single families, duplexes, and quads.
hmm
So we build investment property for our investors. The big national home builders, you'll never see them building duplexes or quads, and that's an
hmm
advantage to us. More roofs under, more tenants under one roof, one loan. A lot of our people like that Fannie Freddie financing, so
I
that's
was
good.
going to say that's what I like about it. It's kind of that Freddie Fannie financing that's just 1 to 4, right?
Exactly. One to
Okay.
four, get those good rates, easier qualifying. It's a great model. And, that ranges our properties from about 240,000 to about 800,000. So
hmm
that's going from a single family up to a quad. Right now, we're looking at a 5 to 7 cap on our properties.
hmm
So with cash flow, we can get anywhere from 6 to 11% cash on cash return. So we're averaging below the 1% rule that a lot of us are taught to follow for getting a house, fixing it up, and renting it. But one thing I've learned is the less turnover and maintenance and repairs, and just even the growth patterns we've seen with our new construction rentals has been made up for that and then some.
Sure. Like on the opposite side of the spectrum, right? You can go to areas and that aren't so great. The product's older, and get seduced by the fact that, whoa, I could buy this duplex for 50 grand. I get $1,000 a month, right? So it'd be like the 2% rule, but then only to find out that, God, the tenant turnover's huge, the repairs on those assets monstrous, right? Just they're ridden hard, they're lived in hard. It's hard to make those numbers work, right?
It is.
So
And sometimes it gets worse, Rob. At least it did for me. The higher you go, I was of this old school thing. Probably about 20 years ago, was the 100 house club. Once you got 100 houses, life was grand. You were set. It was easy street. Well, I way surpassed the 100 house club. But the problem is, if all those things you just listed are happening, it can actually get worse quick. So
hmm
today, and that nearly sunk me in '08. Nearly sunk.
hmm
Today, Rob, I own way less property, but somehow I have way more equity and way more cash flow.
hmm
What does that tell you? That's
okay.
been a big, big lesson for me.
So let's unpack that lesson because there's a lot of wisdom there, right? I remember when I went through this, I remember I used to think that more was better.
Yeah.
And then I was like, whoa, wait a second. More is definitely not better, right? Um, there's this balance between those two. And so let's go back in 2007, 2008, like you're buying these older properties, right? And I know that there's a lot of older stock properties in Florida, right?
Yeah.
Like there's just um what did life look like during that time? Like I wanna hear like the battle scars, the lessons learned, right? Because there's so much that people can learn, and we could save them a lot of pain by just helping them bring their future into today, into the present. So what did that look like having 100 plus houses that were maybe not quite what you thought?
It was a huge headache. It was like cooking a recipe in your kitchen that you were so proud of and sitting down to eat it, and it doesn't taste good, and you got to pretend to like it. That's what I would compare it to, Rob. Because we were just under about 200 houses, so I had way surpassed,
hmm
and I kind
Average
of
rents. What were the average rents at the time?
those rents were lower. They were probably 750
Yeah, I was gonna
to
say eight or
yeah,
nine.
yeah. So it was around there. So it was lower, tougher to manage. Again, I came out of California thinking I was a senior in real estate and got to Florida and I was a freshman again.
Mm-hmm.
Every market's different. You got to learn the areas, you got to learn the fundamentals, the landlord laws, building your team of contractors. There's so many things of, what areas are a deal, what areas are best to avoid. These are all, and you work with lots of, individual markets. Every one of them's different.
Mhm.
And that's the big bitter pill I had to swallow. And
Mhm.
so I'm just turning over, different properties and this and that, and then all of a sudden this roof goes because you were cutting corners to rehab it because you didn't have as big a budget as you thought, and you know what I mean. And one thing I've learned about deferred maintenance, Rob, it always comes when you least want it to. People are like, deferred maintenance. Well, it defers for a while and then it comes due. So and also I was taught get into as many properties as you can. Well, then what if you have to sell? Well, then there's selling costs. You don't have a lot of equity in each property. Today I sit at about 27% LTV over
Mhm.
my whole portfolio. Now, some people are like, oh, you're way old fuddy duddy. You're too conservative. Throw out the line. I've been at the other end, where it was much higher LTV. And I was, yeah, but I have so many properties. But that was actually what was sinking me instead of saving me. I don't know if any of
Yeah.
this makes sense. I'm just kind of,
What 100% makes sense, right? Like I had entered into a market that was a couple hours away from where I lived, where I got seduced by low prices and high rent to purchase prices that were older stock, and I bought a lot of product, right? And what I would do is we did two things. We would buy properties, small multis, and fix them up and sell them turnkey to investors.
mhm.
And then they were like, "This is great, but can you help us manage these assets?" We're like, "Sure, we'll help you manage them." Before I knew it, we had 300 assets under management, all lower rental income, 500 to 600 bucks, right?
Wow.
We owned a lot of the product ourselves, and we worked really, really hard, and we always made money on the when we sold those
All the
assets,
property. Yeah.
right, up front. But over time, like these asset values just kind of like degraded in value, right? And um, valuable lesson I learned, and by the way, you talked about it right in the beginning, is you got to go into growth markets because you need those asset values over time to kind of keep pace with everything, because you need
Yeah.
that equity buildup. um, because I have a building today. I talk about it all the time. It's a triplex that I shut down because it's less expensive for me to shut it down than
Wow.
to keep it rented,
I
right? I'm
get
like, oh,
it. I
maybe
get
I'll turn it into a little park. But these are the things that we learn as entrepreneurs, as real estate entrepreneurs, and every market is different, right? Like you enter every market, there's a different way to make money in that market, right? And you got to figure out who's making money in that market and why. And so why do you think this this new construction piece, right? And you're helping investors build this portfolio. Uh, it's working because it sounds like you can keep the cost of production down, right? Of build down. The the rentals are not the 1% rule, but they're not too far off, right? The ability to be able to have better product that stands the test of time because materials are better. That's another good reason. But Florida's growing like crazy. I guess that would be
it.
the other element, right?
And that's to our advantage. So a couple of things just to backtrack on what you said and agree with. Yes, I mean, turnover is huge until
Hmm.
you own properties. If like you said, we've both gone into some tougher areas. If you're turning over all the time, just the turnover costs are, and then all of a sudden you have a loan as well where you have vacant, so you're paying on the mortgage like that. That slides you backwards. Now you have to make that up so quick. So that that alone is absolutely key.
Hmm.
And if you're wanting to be less involved, you want better properties because people, oh well, I'll have a good property manager. I'm sorry, even with if you're going to be in tougher areas, there's usually more involvement because there's
Hmm.
going to be more calls, more decisions, more problem solving. And I just didn't want that. So for this next go around with the new construction, we said to our investors, you can own less of better quality, and that's it. I mean, that's the simple play, Rob. Because and what I've learned is like there is growth in Florida. Again, I've looking back over 24 years. I've made good money in cash flow, Rob, but I've made way more money in equity growth.
Mm-hmm.
So I
Mm-hmm.
don't depend on appreciation, but I do my best to get in its way. And historically, that's been a good plan for anyone who's growth of real estate. That's not a dummy plan. That's a pretty good plan. Now you don't want to depend on it and say, wow, I'm going to buy this house today for 400 and I'm going to lose $500 a month and hope it goes up to 500 next year and selling. That's not what I'm talking about. We're in a position where you can hold without issue, without a lot of turnover, with good aesthetics, good growth patterns, and look long term. And
Mm-hmm.
that's kind of what we do now. That's what we do with our clients, for myself. And I think with Florida, like you said, Rob, a key thing is the affordability still here. Yes, we've gone up in value and you've seen that. But like, for example, we have a lot of people that come out of California. They came out of California. I used to be out there. I get it. The landlord laws are not the best. There's a 13.4% state income tax. Florida has none, so that's attractive. But a lot of times California investors were leaving California just to go over the border to Salt Lake or up to Boise, Idaho. And those are beautiful markets. Don't get me wrong. But those markets right now are priced about $250,000 higher than our average Florida market.
Mm-hmm.
Yet the rents are the same and the average family income is the same.
Mm-hmm.
So what that tells me is we still have a lot of room for growth.
Mm-hmm.
And we have a more sustainability than a lot of areas. Even the growth that we've had, we were undervalued for a long time here in the most Florida markets.
Mm. Where do you focus on specifically in Florida?
Yeah, we avoid the popular markets. So right now we are not in Tampa. We are not in Orlando. We're
Mm-hmm.
definitely not in the Fort Lauderdale to Miami stretch. Like that's just real expensive down there.
Mm-hmm.
Where we are is Jacksonville. Jacksonville, Rob, when I left California in '04, it was the most affordable coastal city in the nation. And
Wow.
those words don't normally go together. Affordable coastal city. Think about that.
Mm-hmm.
West Coast, it was non-existent. So Northeast Florida was big for us with Jacksonville, Palm Coast. Then we moved inland to Ocala and Citrus Springs and Inverness, been wonderful markets for us. And then a bunch of markets in Southwest Florida, kind of the greater Fort Myers area, several markets right around there, because that area was the fastest growing area in the nation through the pandemic.
Hmm. Interesting. So what have you learned in this process, right? Because I mean, you had to essentially kind of convert your business from rehabbers to builders, right? There was like a transition there, probably
Yeah,
learning curve that happened, right? What what have you learned in that process?
a couple of things. One, starting from scratch is harder in the beginning, but so much easier later on.
Hmm.
Because you can't, you've done enough rehabs, Rob, to see you can't see a sewer main. You can't see behind a certain wall. You
Mm-hmm.
can't, sometimes the roof we think is this old, but it's not showing up on the county record. A lot of the guesswork is taken out of it. So that's really nice.
Mm-hmm.
Now, but I can't stress enough, the upfront is a little bit different. You're not just going to an existing house and starting work, and getting a roofing permit, maybe a plumbing permit. Sometimes you're having to get, the lot developed. There's a lot more steps up front to get it done. So that's something that you just got to get used to,
Mm-hmm.
and that's an important part of the game for sure. Also, yeah, go ahead. Sorry.
Well, I was going to say, and I would imagine that the majority of your investors, just to talk about the other side of it, right? Because there's the building side, there's the piece that you have to go through, um, bringing these properties to life. But on the other side, I'd imagine a lot of your investors, like you said, are from other parts, other states, right? Not necessarily from Florida, or are they from Florida?
We have Florida investors for sure, but we got a lot of investors from the West Coast, a lot from the Northeast where I grew up.
Mm-hmm.
They're sensible to see their own backyards don't really offer the returns they're looking for. The landlord laws, which I am adamant about people looking at their landlord laws for
Yeah.
their individual state now. It's really changed over the last few years. So they're from all over. We also have a lot of international investors.
Mm-hmm.
That Florida has a pretty good buzz to it right now, which we're appreciative of. And yeah, so we come from all over. I'd say less than 20% are from Florida.
How many houses did you guys sell last year to
We did
generate that?
185 million in sales. We've built over 2,000 now, and right now
Wow.
our company is sitting on over 6,000 lots. that we plan to build out in high growth areas of Florida. So
Okay.
too, it might be we were acquired um, in January, a piece of our company by a large building group out of Texas, which is owned by Sumitomo. I don't know if you see Sumitomo in the news. They're a huge Japanese company, 331 years old. So they have
Wow.
a different way of looking at business. I know Warren Buffett is involved in different areas of their business. He's been pro on them, but for the division we're in, this is they look long term. They wanted Florida. They wanted build to rent. And they do 17,000 houses worldwide, which is pretty special for us. And the reason why, Rob, for any building you've done, even if you have a good balance sheet and you're doing a good job, you got to keep going into banks all the time to get this thing. You need an updated file, and you're always extending your building lines. It's exhausting
Hmm.
now. And people are always saying, is this building company healthy? Are they going to go under? Now that we have partnered with them, well, they fund all of our build projects. We don't have to go to any banks anymore. Our parent company funds us, and that's really powerful for people to also say, hey, is your building company solvent? We're able to show a pretty healthy balance sheet, and that obviously puts people at ease.
Yeah, and a 300-year, right, history. It's
331 years old. I didn't even know companies went back that old, to be honest with
Yeah,
you.
it's interesting. I think the oldest company is like 1,000 years old, and it's a
Wow.
like like in that culture, they're generational, right? And they're
Yeah.
just like
Yep.
they're literally generational. So it's pretty impressive. Um, that's a lot of that's a lot of lots. I want to understand the psychological leap that you had to take. And maybe you didn't. Maybe it's just maybe during the foreclosure crisis, you guys were doing hundreds, if not thousands, in a year, right? I
Yeah.
want to understand, like, help somebody understand how to go kind of like that curve, right? Because you start talking about building 2,000 houses. Somebody on this listening to this might just be like, man, I just want to build 100 houses, right? Or
Yeah.
50 houses, right? What? Tell me a little bit about your psychology. Help me understand the inner you, Jim.
Well, first of all, I had a really good partner. I had a really good partner. Again, my building partner and his dad, they had a management company first, and they were managing my personal portfolio. We had already done things back and forth and had a good relationship. So this was an experiment, and we were willing to experiment. That's maybe one of the key things here, Rob. I
Mm-hmm.
mean, I was the old dog doing old tricks. I knew how to find an old house, fix it up, rent it, or sell it. I mean, that was my whole niche to wealth right there. I don't really know how to do much else.
Mm-hmm.
And so it was big to move away from that. But I could see so many pain points in that model that I had to be willing to, the old Napoleon Hill burn the ships.
Mm-hmm.
Remember that one
Mm-hmm.
for the old warrior battle? They showed up
Yeah,
for that battle.
conquistadors burned the
We
ships.
burned
Yep.
the ships behind them and said, we win or we perish.
Mm-hmm.
And so we really started to just stop doing rehabs and went into this. So I was willing to experiment with something new, still within my core competency. It wasn't like a leap where I was like, oh, I rehab houses, so now I'm going to go buy car washes. It's just
Mm-hmm.
like, that's a pretty big leap. Not that I know people make money, but I don't know anything. I'd be a real freshman in that. So this was a new experiment. And then I was willing to burn my ships. I don't rehab houses anymore. If people
Mm-hmm.
come to me and say, hey, will you find me an old house and fix it up? The answer is always no. I just,
Mm-hmm.
I had to burn my ships in that old niche. And that was key. And by giving that up, again, I really, really believe in that mentor's advice almost a quarter century ago, Rob. Can you say your real estate niche in one sentence?
Mm-hmm.
And it doesn't mean that can't change, because mine's changed, but that's what I do. I do build to rent properties in high growth areas in Florida now. Boom, that's it. And
Mm-hmm.
by giving myself the hyper focus of that, we could get on the inner circle. I mean, the what's it called? The inner track of better deals, better understanding, and then people also know where to go. You and I will get off of this call, and hopefully we'll stay in touch. But in a few months, someone's like, I've been looking at this build to rent, and I'm in Florida. You'd be like, I know that. Even if someone just says build to rent, I did someone on the podcast. You should talk to Jim. People know where to find you if you identify yourself in a very clear niche.
Yeah, I call that zoning a market. right? It's zero in on your target market or your prospect, own the mind share of that market, network and build your database, and then engage your community like in service. And I found that that hyper focus is what separates people, right?
Yeah,
It's like it's saying this is what I do and I stick to this thing, right? Get known for something, become famous at something, right?
yeah, yeah.
Another way to put it.
And
Um,
people, one thing too, Rob, people say like real estate investing is not exciting for me. And people might go, oh, that's terrible. But again, I was taught that if you really hone down on a niche, first of all, you're going to do better, you're going to be more competent, and it almost becomes boring, like a printing machine. Like, all right, we're going to crank out another, we're going to crank out another, and people are like, oh, well, that's terrible. I'd rather be thrown into this new this and that. And well, I have lots of excitement elsewhere. I take lots of family adventures. I love
mhm,
surfing. I'll have my
mm.
adventure in the in the ocean. If
Costa Rica somewhere maybe.
Yeah, I'm there part of the year actually in Costa Rica. So,
Hmm.
but again, there's nothing wrong with getting so good at what you do that you just continue that you're not figuring it all out every time. That might feel exciting, but when you look at profitability, time away from your family, that can be a huge time suck and wallet suck.
Yeah, it's getting comfortable with the boredom of mastery, right?
There it is. Great.
And
Well said.
and when you become a master at something, it's just like, one of the ways to think about it. Another way to think about it is, just look at a professional musician that plays a song that's a famous song, right? Like James Taylor, Fire and Rain, as an example. Like, how many times do you think James Taylor has played that song, right? But he's got to play it like it's the first time because somebody heard it for the first time, like in concert. And it's just like, do you think he's bored playing that song? 100% he has to be bored playing that song. But that is what a master does,
Yep.
right? It's what
Yep.
a master does. So, um, what let's talk about some of the bumps and bruises, right? During the foreclosure crisis. How did you navigate that whole process? Just curious.
Foreclosure process. Yeah, that was really hard, because I mean, talk about California. I mean, I don't see anything like that happening again for quite a while.
Mm,
But we lost 40% of rents, 50% of value. So even at a decent LTV, you were in trouble.
mm.
So what we had to do is get medieval with our overhead, Rob. And I mean it. We really did cut to the bone, and I took a different path. I took a path I'm not suggesting people do, but I threw all of my chips back into the business to save it and protect our investors. Now, for me, it might have been a more of emotional. I'll say that I had a lot of close family and friends that were investors, but I kept them whole through the whole meltdown.
Mm,
And that reputation spread. And so as we had finally held our feet, and it was thin where I was like, I don't know if I'm going to make it through this. We made it through just enough where, I think Peter Lynch said the best time to invest is when there's blood on the street, even if it's
mm,
your own. That
mm.
was it. We kept our feet just long enough. So many people had just gone bankrupt and out, and the deals were just unbelievable. And we had built this reputation that we protected our investors through the downturn. They said, "No, no, no, we want to hire you to start getting us these great deals." So we kept, working right through it. So that was absolutely key. I got real medieval on my overhead. Um, had to.
Jim, what was your model then when you were going like in 2006, 2007, 2000? What was your model at the time? Because it
Yeah, my
sounds like,
model then was I was just such a buy and hold guy. Most of them I was just buying and holding for myself or with a
mm,
partner. And that's where, Rob, man, I mounted up properties in that 06, 07 that I bled me for 12 years and then finally was able to get rid of them. Kind of like that triplex you shut down. So and that was the model where I was like, well, holding property, you got to hold property. You hold property, it's going to go up. You're going to do it. There's some truth to that, but as we discussed before, how is it held in those first 5 years? Is it going to have turnover? Is it going to be ridiculous to manage? Is it? And I didn't look at that. And I was a
So the
freshman.
so the investors that were with you were private lenders that had lent you money on those
They
assets,
were
or what?
actually, I was doing an old model that I don't do anymore, where I would do all the work. So
Mm,
they would either put up the money and I'd sign on the debt, or they would sign up the debt and put on the money and put up the money. So that's a pretty dangerous thing when you got people's credit on the line too. And I'm proud to say not one of my credit took some dings. Not one of our investors got a ding on their credit. We
that's awesome.
protected all of them through it. So I wouldn't recommend that model. That look, if you're going to go into a partnership with someone, you're putting their credit up, be ready to back that property.
Yep.
Um,
So when all these opportunities started opening up in Florida, because I mean, you guys were like ground friggin' zero, right,
it,
during that time.
yes,
I mean, it was in 2008. I bought a bunch of properties with a wealthy guy here in this area, and I look back and say that was the smartest thing I've ever done. I should have bought a
more.
thousand more, right? I should have bought a thousand more. But it was a scary time because every sign in the yard was either a foreclosure or short sale. And it seemed like Lehman Brothers had just filed for bankruptcy. It was crazy,
It
right?
was crazy times.
Um, what did what did you do? How walk me through like that 2008, 2009, 2010? Like what it sounded like people started coming to you and saying, "Hey, help us find these deals." Were you selling, bulk assets? Were you hold like
I always, it's funny. I talked to my sales team about this, about, singles and doubles. There's always people, and we work with some larger institutions come by. Oh, we're going to buy 50, 100 properties. That's great. But it used to be the opposite in the foreclosure days. Hey, this guy's got a package of 50 properties you can buy. It's like just this carrot on the stick. And I was like, you know what? Every Monday, if I wake up and by Friday, I've got 3 new contracts on houses I've handpicked, I'm probably better off. And sure enough, I'd see friends that would try to work this 50 house deal.
no, it never came to fruition. It was
No,
like all the tapes that like everybody's like, "Oh, I got this." It was like
this tape,
never.
yeah, it's like,
Yeah.
oh God, here. And so they worked this thing for 4 or 5 months and would fall through. And I'm like, I just did my 3 a week, and it
Hmm.
it treated us well, and then that even picked up from there. So yeah, it was really private money groups
Hmm.
coming to me and saying, hey, we either have a group of investors that want to get into your area. And then I had private money guys approach me and say, hey, we want to create a loan program for you. We trust you on this. We see it. You give us a piece of the action. So I really just started to do some joint ventures with people that would hire me, and then also people that wanted to partner with me.
Hmm.
And so, I had access to, which is unheard of in 2009, 100% financing, because I was getting us into the property so cheap. They liked the risk of it. I wasn't have to go to any banks. I just showed my business plan to these few private money groups, and they liked it. They had some of them that approached me, and they said, "Great, we're in." And so that kind of like what I talked about now, that ability of financing, Rob, to scale is so key.
Hmm.
In '09, I was able to do it because I didn't have to go to a bank and convince them, look, I'm buying this property below replacement cost. This is what it sold for in 1978. Like, I was able to just go, go, go. And that's kind of how we feel now with our building operation, having a parent company fund us
Hmm.
without having to convince banks. So
Hmm.
that is absolutely key. I think there's 3 parts. You got to be able to find the deals, you got to be able to finance the deals, and you got to be able to manage the deals, whether that means
Hmm.
fixing it up and selling it, or, building it and selling it or renting it. There's only those 3 pieces. And I got lucky, I think, holding our feet through '08. By '09, we had a lot of money coming to us to put to the market, and we made people a lot of money with it.
So the model today is you build these and you sell them to other investors that are looking for a long-term return, typically business owners that, you know,
Business
are,
owners, professionals, a lot
yeah.
of doctors and dentists that I've met through the years and had worked with for years. So a lot of successful professionals that don't necessarily want to leave their jobs or careers, but they want to have some real estate in their overall portfolio.
Okay. And so that's creating your active income, right? How are you continuing to build that passive income side, or are you even focused on that at all?
Yeah, no, I'm still very active in our build to rent ownership, so and always building my own portfolio. But the good news is I got at that point where I went into higher homes, just like I'm teaching here, and there's higher cash flows and very little debt. So
Mhm.
I'm always adding properties to my portfolio a lot slower than I used to. And I have a lot of ownership in build to rent properties. So I'm always growing that side. So there's,
Mhm.
obviously the transactional for what we do, but then there's also what does the build to rents for our company produce as well, because we hold properties as well.
Yeah, I would imagine that would be part of it, right? It's like you're making the business is turning cash, right? And bills get paid, people get paid, families get fed, right? And then you're converting that cash, and your business, I would assume, would be also be building a portfolio of properties, better properties this time, right?
Much better. Yeah, there's no
Much
comparison.
better assets, less, a lot less headache, um, in that 1 to 4 space. So that's interesting. Do you find you have a preference? 4 units, 3 years, 2 units? Does it matter?
I've owned all of them. It depends on what you're trying to do. I think that, quads are unicorns. They're harder to get approved, they're harder to find. I think that for people who are looking to grow their portfolio and just starting out, I think it's a great way. Because, like what we talked about, you can leverage a Fannie Freddie loan to the max.
Hmm.
So, I mean, I work in all three of our properties. I think quads are obviously something that are pretty interesting, and that could produce the biggest cash flow growth for you because it has the best odds.
Hmm.
And then duplexes are an interesting combo because you don't get as many renters under one roof, but they sit in this interesting little zone where yeah, it's an investment property, but we've sold plenty of duplexes to retail buyers.
Hmm. Yeah,
I
that's
mean, it is not uncommon now for a retail buyer to say, "Yeah, I'm gonna buy it and live in one side and rent the other." That's become more and more known. So it'd be tough for me to say which one, Rob, because I've worked in all of them.
hmm.
But I think for investors who are really serious, they're wanting to get in, do a mixture of them, and especially a few quads is great, because again, Fannie Freddie will only finance you for up to 10 properties. For anyone who doesn't understand that, that's the better government financing that a lender will be able to get you. And, you want to take advantage of those because you'll still get loans after that, but they're at a little higher interest rate, more down, and that might be something you're not wanting to do.
Jim, what's your outlook for 2024?
Much better than 2022, 2023. Like
Hmm.
when 2022 hit and those rates just started to, skyrocket, it got, I mean, the brakes hit screech even here in Florida for a few months, and we're going, what the heck? And I feel that the Fed has an interesting history. If you look it up, Rob, anytime they've ever had these quick spikes in raising the rates, within 18 to 24 months of starting that, they've trailed back down, and normally a big trail down, like 2 points.
Hmm.
And that's pretty healthy. So this started in June of 2022. My thinking, and a lot of thinking of people much smarter than me, is the Fed can only press this so high. We're kind of at a fragile state, and they're going to have to start to trail that back down. They're trying to slow down the inflation, the markets, and I think, right or wrong, there's been some of that done. Um, but I think 2024 that rates are going to come back into favor even more. And that's going to accelerate more growth in certain areas of the U.S. Certain areas of the U.S. are going to struggle, just like in '08. There were parts, Rob, in '08, people don't talk about that were fine. I had friends in some different markets. They said if I didn't watch the news, I wouldn't even know about this big meltdown. I was like,
Hmm.
thanks a lot. I'm staying over here. Um, so I think,
Florida. I mean, all the sand states. I mean, got crushed. I mean, here in the Northeast, it was bad, but it wasn't like you guys. I mean,
no, yeah,
we experienced 50%. Like there was neighborhoods, there was pockets, right?
yeah, yeah, yeah.
There was pockets where we were that experienced like I was like, wait, this thing peaked at 350. It's now a buck 50. Like, how is this not a good plan, right? Like the rents are $1,500 a month. Like this is ridiculous. And then we just dollar cost average those properties down.
Yep.
Um, so where do you want to take this in the future? Like, what's this look like 3 years from now, 4 years
Yeah,
from now? I mean, you guys
I
just
think
made a big move. Like getting bought by this company was a big move.
Yeah, and it's
Right.
perfect. They have shown, a lot of the builders that they bought where my partner was going out and talking, you can leave in like 2 years after a thing like this, but a lot of them were still on 10, 12 years later. And we'd like to keep doing this. So they give you good autonomy, good support. So we'd like to keep growing this. We were at a great dinner last week with some some people that were now a part of us, and we see this as being able to pick up, just like we went from Jacksonville to a dozen other markets in Florida. We see us being able to grow this into both Texas and Tennessee are our next two moves.
Hmm.
We like the fundamentals, we like the state, we like the landlord laws, and our parent company is already set up there. So we see this as an exciting opportunity to grow that and replicate the model. And again, with our investors, they might say, "Well, I like that state. I like that state. I've been wanting to go there." So we see it as becoming more of a larger service to more investors using the same model, though, just kind of rinsing and repeating.
Just out of curiosity, where in Tennessee you're
I
looking at?
haven't quite known it. They're in a couple of different areas. Nashville has gotten pretty expensive, but there's some other, more affordable markets like Knoxville and other areas
Yeah.
like that.
Yeah, yeah. We just opened an office in Knoxville,
Yeah,
and
Knoxville's a great little market. I mean, that's a
Knoxville's
great,
great.
good lifestyle. Has good affordability index. So I think Tennessee has some real solid fundamentals for
Yeah,
people.
for sure, for sure. Okay, let's switch it real fast, and let me ask you some personal questions. You said adventures. What kind of adventures do you go on?
Yeah, well, wow, we could take quite a few adventures. So
Okay.
that was one of my things. It's not what, it's the how, Rob. I've always said I want to be able to have that legendary family life my parents couldn't afford, and I always dreamed of. So we take 6-week RV adventures.
Mm,
We bought a house in Costa Rica a few years ago. We live there, work and play from there a few months out of the year.
hmm.
Um, we've gone to Australia. We're going to Ireland this coming month.
That's cool.
Um, yeah, so we've gone and done service work in Guatemala, and in Mexico. We've explored the Bahamas and the Caribbean islands. We've gone up to Nova Scotia for weeks at a time. It's so that's we kind of go all over. We're definitely more warm weather, but we will venture some of the cold weather.
Oh yeah, I'm all about the warm weather. What part of Costa Rica? Just out of curiosity.
We bought a house in a town called Nosara, Costa Rica, which I've been
Love it.
going to for about 25 years.
Yeah, Nosara's great. I started taking my family down to Santa Teresa, Costa Rica.
Yeah, I've
Right,
heard that's beautiful.
it's gorgeous. Great
Yeah,
if you're a surfer. Great surf place. Right,
yeah, I've
great
heard.
yoga. Great surf place. We looked at possibly buying a house, but I couldn't
It,
justify the numbers. Right.
it's an emotional move, Rob, and one of the most emotional reasons is you got to pay cash. So, paying cash is, I don't like to leverage now, but I like some leverage. So I was like, what do you mean there's no loans? And we actually were able to work a little bit of owner financing for 2 years, just to get some. And now we had to pay it off. And the good news is it has appreciated. But if you're going to Costa Rica, it is more of an emotional purchase.
Yeah.
I think there's going to be use, and then we get great vacation rental out of it when we're not there. But you do have to pay cash. You lose that leverage effect.
Yeah, yeah, yeah. I just said, you know what? I'll spend. I think I was sharing with you, right? I want to get out of Dodge when it gets cold around here, so
Yeah.
we'll spend a month out of the year in Costa Rica,
Oh,
right?
nice.
And then we'll spend the rest of the time of the year in Florida somewhere, right?
There you go.
That'll, you know, um, we don't know where in Florida. I like St. Petersburg. We talked about that. But who knows? I'll go. I might go visit you in Jacksonville, right?
Yeah, well, I'm
Coach.
in St. Augustine, which if
Oh,
you've
you're in
never been
Sado?
to St.
Oh yeah,
Yeah,
that's great.
it's a great little city. It is just if you like Charleston and Savannah, it's got that old charm to it, and it's actually older. It's the
It's the
oldest city in
it's the
America.
oldest city. Yeah, yeah. I just had a friend of mine move there,
Oh
right?
yeah,
And he absolutely loves St.
it's a
Augustine.
great little town. Great little town. So it's got everything from little shops to really cool restaurants to beach communities and activities, and yeah, good fishing. There's good stuff here.
Okay. Well, I may have to go explore that. I think that's the biggest thing. Florida's so big
It
that
is.
you just have to explore the different parts, right?
Yeah.
Because even within St. Pete, you've got the beach, which feels very different than
Yeah.
the Bay Area.
Yeah. Yeah.
Completely two different
They
worlds.
really are.
Yeah.
Yeah. And I think people think St. Pete's like it's a cool little downtown over there. Like it's its own
Oh,
city.
it's its own little ecosystem,
It
right?
is.
For
Yeah.
sure. For sure.
Yeah. I love that.
Well, hey, I appreciate you spending time, Jim, with us. I think what you've done is helped a lot of people that are on this journey, right? Kind of understand maybe some of uh, the pitfalls
Hmm.
along that journey that I see a lot of investors get trapped in, right?
Yeah.
As they're building things, right? Um, sometimes you're building something and you realize you actually put your ladder up against the wrong wall. It's not the it's not the wall you should have been building, right? But you still learned in that process. I think a lot of us kind of go through that. Um, any words of advice as people are building their thing and
Yeah, I mean, again, niche is really important, and then it's okay to experiment outside the niche to try to transition to the next. And like for build to rent, you don't have to start with a ton of houses. You heard we started with a small group, and even just try building one. And I wouldn't have given that advice a year and a half, 2 years ago, because the material supply issue was just so dreadful for really small builders. But I think that's starting to come online. But you can always experiment with one. If
Mhm.
you're a rehabber out there, you're, and you want to try building one house, it's probably not going to kill you, and you'll learn so much from that first house. So try one. Same thing with investors out there. If you've owned older properties, maybe look at trying one new construction, see where it is. Maybe it is a higher buy-in and different what you're looking for, but it's always good to, again, experiment, put something on the track and see how it actually performs against your norm. That's how I've continued to evolve, Rob.
Mm. Jim, and if people wanted to find you, if they were wanted to own something in Florida, right, rentals in Florida, how do they find you? What's the best way?
Yeah, you can go if you want to look at jjplaybook.com. That's something my wife and I wrote about our journey into real estate and how we
Mm,
came into build to rent. So you can go to jjplaybook.com, or you're welcome to look right at our building company, southernimpressionhomes.com.
okay, southernimpressionhomes.com or jjplaybook.com. I like
Yep.
that.
Yep.
Okay, we'll make sure that we put that in the notes.
Cool.
Jim, thanks so much. I know the grid community is going to thank you for this. I know I learned a lot today, so thank you. And as always, man, just have a great day. Nice
Yeah,
meeting you.
you too. Thanks, Rob. Appreciate it.
Take care. Bye.